So my question to you is, and you really need to think about this, do you still trust those insurance contracts? People think, well, it's insured, it's safe, but quite frankly, there is no real guarantee. Any contract is only as good as the other entity on the other side of that contract. Several weeks ago on the live, somebody brought up the private credit into insurance companies, and I've been working on that in the past. And I thought, you know what? It's a good time to update it. So that's what we're going to talk about because frankly, cheap money, sticky capital, which would be your payments to the insurance company, really inspired private equity's insurance company takeover. Because after 2008, central banks opened the money spigots really easily, printing fresh cash and holding rates near zero. It was like turning on a fire hose in the financial system. Cheap water everywhere, little oversight, and anyone with a bucket could scoop it up. Private equity firms didn't just grab buckets, they built pipelines. They realized that insurers held sticky pools of water, premiums that flow in steadily and don't evaporate quickly. But by tapping those reservoirs, they could fund massive deals and pile on leverage, confident the inflows would keep coming. Well, that makes a whole lot of sense because today, firms like Apollo, Blackstone, KKR, Carlyle, and Brookfield have all built major insurance platforms on or partnerships, frankly, using insurers' balance sheets to fund a private credit growth. How awesome is that? Well, frankly, the danger is obvious when too much of that water is locked into those deep wells, which are really, frankly, illiquid assets, and households suddenly need it back. The system strains, and what began as a flood of easy money has now become a network of hidden pipelines where insurers' obligations and private equity's hunger for yield are now inseparably tied. Well, those premiums, they grew 80% between 2000 and... So you think, I know we've all been experiencing that, but you think that growth in premium reflects really just a steady expansion in global demand for protection? Oh no. It's also the hunger of those private equity groups into that pool of sticky. You know what I mean by sticky? Means you make those deposits, you pay those premiums. If you're buying an annuity and you just fund it, that's long-term capital. You're probably not calling tomorrow and saying, I changed my mind. So even as the premiums grew 80%, private equity exploded 750% over the same period, which far outpaced that premium growth. As premiums rose, insurers became attractive permanent capital pools that fueled private equity's exponential involvement. Shocker. And look at this. In 2025, premiums have plateaued a bit, although we're now warmed. They're going to explode again. But that's because private equity stabilized at very high levels. And all those entities that we talked about, this is a structural shift. Insurance finance is now deeply intertwined with private equity strategies. And people think, well, it's insured, it's safe. But quite honestly, regulators are warning that private equity's rapid growth relative to premiums could amplify mismatches between liabilities and illiquid assets. And what that means is that the demand to get that money back out, let's say you've got an annuity, well, what happens if what that wealth is funding is illiquid? You can't sell it. But this structural shift also means that insurers became permanent capital pools for private equity firms. And this changes the liability management because really, insurance companies had to have an obligation to investors to pay out, whether it's a life insurance company or an annuity company. And remember, if you look on your contract, any contract is only as good as the other entity on the other side of that contract. And so if private equity has all of these illiquid assets that are inside of them, you've got a big problem if too many people want their money back at the same time. Now, of course, the Bank for International Settlements warns that private equity's expanding control of insurers through acquisitions and asset management They create these products and they sell them to the insurance companies that they own. That's actually heightened systemic vulnerability. Fitch notes, that's one of the insurance companies that affiliated. Insurers now allocate a full 24% of portfolios to private credit and complex assets. Complex meaning they're opaque versus just 6% at non-affiliated peers. So if an insurance company's been taken over by private equity, a full at least 24% of their portfolio is in these illiquid assets, and it's a complete lack of transparency because as a private equity, they don't have the same level of oversight. So that transparency of debt that's popular with U.S. insurers increases the risk of fire sales. In other words, if a lot of people demand their money back at the same time, well, the insurance company's going to have to liquidate whatever they can to generate that income or to generate that cash to pay out on that demand. And so the reliance on private ratings is one way to build these debt portfolios in a way that actually transfers that systemic risk to you, the investor, and even to the broader financial markets. This is all according to the Bank for International Settlements, the biggest bank in the world. Insurers are shopping for grades just like the banks did before the 2008 financial crisis. Remember, grading services are paid by the companies that they are grading. I don't know. What do you think? You think they might have a little bit of a lean toward what these companies want? The insurance industry, especially in the US, was engaging in what's called ratings arbitrage, and that is finding a lower and lower rate. And also that also means that they're just not looking as closely. In fact, take a look at this. The big asset managers like Blackstone and Apollo now rely heavily on smaller rating firms, not just the big three. And you can see it here just how those smaller rating agencies are dwarfing and taking all of this business away from the larger rating agencies. You know, they offer faster, more flexible, I love that term, service. Egan-Jones, as an example, with only 20 analysts, issued over 3,600 ratings in 2020, and another so far 3,400 in 2025, making it the busiest grader of loans to individual businesses. When you look at the big ones, you know, Fitch, S&P, etc., they are rating a fraction of those with a lot more rating agents. I don't know. How careful do you think they're really being? Do you remember what happened in? They had all these justifications for a rating that exploded in everyone's face and caused the great financial crisis. And so, yep, there has been an explosion in the number of privately rated securities that can then be sold to those insurance companies. Now, can you see in this graph that the link between private equity participation in insurance companies and those insurance companies that are buying products that are created by those same private equity companies, and they're being graded in volume along with a rise in new grading services and flexible grading? Boy, I really hope that you have your sound money strategy in place, because if you're sitting on an annuity and you think it's safe because after all it's insured, you better have the right kind of gold to offset it if and when it goes to zero or somewhere near that. Because remember, all insurance products' ability to pay out is based upon their claims paying ability. Look at your contract. It says it all over there, but you might not have paid much attention to it. I suggest you do. You're led to believe that the insurance will be there when you need it, but quite frankly, there is no real guarantee, though there is an awful lot of counterparty risk. Because again, any contract, which is what an annuity is, which is what a life insurance contract is, what any insurance contract, right? It is only as good as the counterparty to that contract. And there's been an awful huge shift since 2008 in who really owns these contracts. Tax, because 37% of North American life insurance investments sit in private equity. And here's a whole list of a whole bunch of those insurance companies that have an awful lot of investments in that private credit. In fact, level 3 assets. So that green bar in that chart that you're looking at, well, they are valued on on observable impact. That means they're valued at whatever the private equity and insurance company wants to value them at. and 20% of U.S. life insurers and the fixed income assets fall into this very, very opaque category, which means you can't see it come. Moody's looks at it and says that the sector holds 85 billion in illiquid opaquely rated assets. If you're sitting in an annuity, I hope you understand what I'm trying to show you here, because then I would question just how safe do you feel. Looser rules could breed more cockroaches in the lending market. Didn't we just hear Jamie Dimon talking about that? And it were inside of an environment of deregulation. So my question to you is, and you really need to think about this, do you still trust those insurance contracts? Do you even know what's going on inside of your insurance company? I'm guessing, frankly, that you really don't, because here's the big question. How's liquidity in the U.S. life insurance sector deteriorating, Bob? Why? Because when the Federal Reserve dropped interest rates to zero, and all central banks did the same thing, but when they dropped interest rates to zero, well, then that forced the insurance companies to go out on the risk spectrum. Is this an unintended consequence of all this money print, or is this just the setup, a planned setup to the next crisis? We're about to find out, but I want to take you into a little case study so you can see what I'm really talking about. And Blue Owl is a great case study in private credit strains, because they just recently had to scrap a merger. They abandoned the plans to combine two private credit funds after investor pushback over potential losses in those level 3 assets that you really have no idea what they're worth. And how did the market react? Well, the shares fell to their lowest levels since. And what that really underscores, because I don't really care what happens with the price action in stocks, but I do care about the emotions that are tied to it. And what this is really showing you is fragility in sentiment. So as long as everything is hunky-dory, great. But when it isn't, it evaporates very quickly. Leadership is blamed negative articles for the decline, insisting there's no emergency here in its business development or anything that they're doing. But we heard that same kind of language before. What happened? Do you believe it? Because if you do, there's a bridge in Brooklyn that we really should talk about. Not really, but this doesn't fix a problem. It just creates new ones. And we have to look at it in the broader context, because frankly, private credit's rapid growth was fueled by that cheap money. That and insurance sticky capital, your deposits, your premiums, and now it faces scrutiny when the losses loom, which then brings up loss of confidence. And what we're really looking at here is systemic vulnerability. Investors' confidence can unravel quickly when opaque structures are questioned. And it ties back to the insurance role as permanent capital pools. How nice! They are now exposed to reputational and valuation risks right alongside their private equity partners. But I will remind you, in August, U.S. President Donald Trump signed an executive order allowing alternatives, including private credit investments, into your retirement, your 401k plans, another pool of captured equity. And that is a move that is set to benefit asset managers by opening up that $12 trillion market, that retirement market, to those alternative strategies. And so you have to wonder who in the world benefits from this. Is it really you and me? Or is this really another wealth transfer mechanism, so that the 1% benefit and you and I are left holding the bag? I hope you can see how important it is for you to create your own insurance network by having a foundation of sound money. That's what our strategy is all about. But you also need to create that independence, and you do that with the mantra and coming together in local community and making sure that you have surety in food, water, energy, security, barterability, wealth preservation. That community piece is critical, as well as shelter. Become your own central bank. Create a foundation that they can't take away from you with their lies and their contracts. This is not the time to trust. This is the time to come together. And not only is the local community important, but that global community is critical, because this is also our opportunity to get redeemable gold, sound money back in the monetary system again, and take our power back. No, it's not convenience. Freedom is not convenient. Ethics are not convenient. but they are critical, and this is the time to do it. And so I task every single one of you that are watching this to look in the mirror and say to yourself, well, if not me, who? And if not now, when? Because one person doesn't stand a chance. But 3% of the global population voting for sound money back in the system, and you can do it just by converting your garbage fiat into sound money. Now we can make a positive difference for the world, for the future, for the current generations, and all those yet to be born, and we have to do that. That is our obligation as human beings, is to leave this world in a better place than we found it, and we can do it together. I know that. Not one doubt in my mind. Together we can do anything. And until next we meet, please be safe out there.